Buy low and sell high. That is the investor's credo. Or at least it is for many investors. Momentum investors, though, are different. They aim to buy high in the hopes that they'll eventually be able to sell for even higher. And they believe that this incredibly simple to implement approach is able to beat the market consistently and over extended periods of time. But is that true? Can buying high and selling higher actually lead to superior results? And if so, why isn't everybody doing it given how simple it is to implement? That's what we're going to be looking at today. Let's talk about momentum investing, how it holds up historically against the more popular buy and hold strategies, and other things that should be taken into consideration before deciding whether or not to implement such a strategy for yourself. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to my Patreon page. This is the best way to show your support for this channel, and in addition to that, you can also get early access to new videos and exclusive content such as spreadsheets based off the ideas we discuss in these videos. The spreadsheets will allow you to play with your own numbers and see how big of a difference some of the ideas we discuss can make for your own personal financial situation. So what is momentum investing? Well, it actually encompasses quite a few variants, but at its most basic level, momentum investing is simply an investing strategy that operates under the philosophy that the recent trend of an investment will continue into the near future. Basically, it's Newton's first law of motion transplanted into the investing world. An object in motion will stay in motion at the same speed and in the same direction unless acted on by an unbalanced force. Momentum investors seek to find themselves investments that have a strong upward or strong downward trend and then invest accordingly. For investments with a strong upward trend, momentum investors will buy as many shares as they can afford, sometimes even utilizing leverage to do so, believing that, more often than not, those investments will continue to appreciate in value. At least over the short term. Momentum investors usually reevaluate trends many times a year. Investments with a strong downward trend will often be shorted because the expectation is that they will continue to lose value, at least in the near term. What you'll notice is that this strategy differs from other popular approaches in a couple of ways. It's different from the more standard buy low, sell high strategy employed by value investors, instead opting to buy high and sell higher. And it's different from more technical trading strategies because momentum investors generally don't care about the fundamentals of the company. Their focus is aimed squarely at the trend of its stock price. This also makes the risks of a momentum trading strategy quite clear. If your investment runs into an unexpected, unbalanced force, you could stand to lose money, and possibly quite a lot of it if you're using leverage or trading with less diversified investments, such as individual stocks. So, have momentum investors been rewarded for taking on this additional risk? Let's find out by comparing the historical performance of momentum investing against the standard buy and hold strategy. There are a lot of ways that we could go about analyzing the historical performance of momentum investing relative to buy and hold strategies, and I can't go over all of them in the span of a single YouTube video, so here's how I'm going to do it for today. I'll assume that George uses a standard buy and hold approach, and he'll invest all of his money into a simple total stock market index fund. Pretty simple, but historically speaking, it's been pretty effective too. Jackie, on the other hand, will have a momentum investing strategy. She'll be looking at the annual total return of a variety of different assets, such as large, mid, and small cap stocks, including the growth and value tilts for each size category, bonds, both governmental and corporate, gold and other precious metals, and real estate to make her investment choices. For now, we'll say that Jackie invests equally in the top 5 performing assets from the previous year in the hopes that they will continue to outperform the other investments in the following year. The two things I'm most interested in seeing here is whether this strategy typically outperforms the buy and hold approach in terms of growth, and if so, by how much, and how much consistency and tranquility Jackie may be giving up to get those returns, which we'll be measuring by metrics like standard deviation, loss frequencies, and risk-adjusted returns. We'll run a few simulations to get an idea of how these strategies compare to each other in these metrics using different investing time horizons as well. The simulations will cover the period between 1929 through the end of 2020, since 1929 is the first year for which I can get an idea of which investments the momentum strategy would actually choose based on the prior year's performance, and 2020 is the most recent fully completed year that I have available to me at the time of this recording. Also, there are some considerations that, due both to their complexity and how unique they can be to each individual situation and investment, will not be modeled here, such as the potential difference in expense ratios, trading costs, and tax consequences between the two strategies. Generally speaking, since momentum trading is buying and selling more often, there will usually be more trading costs and possibly tax consequences associated with it. So to make up for it, the momentum strategy will have to generate noticeably higher pre-cost returns in order to be considered the superior approach. Just keep that in mind as we're running through these numbers. With that being said, let's get into the results. If we look at single year performance, we can see that, on a pre-cost basis, Jackie's momentum strategy only manages to outperform George's buy and hold approach 45% of the time. Its average annualized nominal returns hover around 10.6% compared to the 11.1% produced by the total stock market index fund since 1929. However, on the bright side, the momentum trading strategy actually posts better risk-adjusted returns, standard deviation and downside deviation figures, and even loss frequency figures than the buy and hold approach during these years. So there is that. On your screen now, you'll see the 3, 5, 10, and 40-year performance results using the same assumptions. And as you can see, over longer time periods, the momentum investing strategy has outperformed a buy and hold approach, though it isn't by an overwhelming edge in terms of returns or overperformance frequency. However, this actually might be a little unfair to Jackie. Since the stock market is so much more volatile than things like bonds, and since we're only looking at the relative performance of the previous year to make our investment decisions, it's entirely possible that Jackie's actually investing a substantial portion of her money into investments like bonds in a sizable amount of these years. And since bonds tend to earn lower returns than stocks in the majority of years, should we really be surprised that George's all-stock approach managed to hold up reasonably well in most of these results, even if he did experience more volatility than Jackie in doing so? Probably not. So how would the results change if Jackie only considered the relative performance of stocks when making her investment decisions? Here's how the results shake out if Jackie is only investing in the prior year's best performing stock funds. As you can see, in both outperformance frequency and magnitude, this all-stock momentum investing approach tends to fare better. This seems to be especially true over longer time periods, with the 40-year simulation showing a near total victory for Jackie's momentum investing strategy. However, as we would expect when giving up other assets like bonds, it did become more volatile and prone to down years compared to the previous momentum investing approach. With that being said, why is this the case? Why does something so stupidly simple and very exploitable by even the newest of investors seem to beat the market? When we learn about investing, one of the first things we learn about is the efficient market hypothesis, which basically states that the price of an investment reflects all available data about that investment, which essentially suggests that it's more or less impossible to quote-unquote beat the market, because all of the available news surrounding an investment has already been priced into that investment's share price. In other words, there are no bargains to be found. But that clearly isn't true. Or more accurately, judging by the numbers we just went over, it probably isn't 100% true for every investment all the time. There are bargains to be found because even if the invisible hand of the market guides investors at large to trade until they've arrived at a fair market value for an investment, there's still a time delay between that news being released and investors rediscovering the fair value of that investment. And then there's also the ideas of risk premiums and irrational exuberance, which seem to be the two reasons I saw given to explain why momentum investing has tended to work despite seemingly to fly directly in the face of the efficient market hypothesis. Though I should note that there really isn't a fully established consensus answer to this question as of yet, so take these proposed explanations as that. Proposed explanations. Risk premium in the investing world is just a measure of how much additional return an investment provides over some risk-free alternative. Generally speaking, the riskier the investment, the higher the returns that investment has to produce for people to be willing to put their money into it. If we assume that the short-term riskiness of an investment rises as the price rises, particularly if that price is rising at a faster than average rate for that investment, then it would make sense that there would need to be a risk premium for that investment in order to compensate investors for taking on that larger risk. Once that risk premium becomes too small, sentiment for the investment becomes bearish, and we see a correction. Based on this explanation, momentum investors would just be being rewarded by taking on this additional risk more often than a buy and hold investor. And that's why we see it outperforming. The second hypothesis is that momentum investors are using their knowledge of human psychology and cognitive biases to their advantage. We've covered investing biases on this channel before, so I won't spend too much time on them here, but it has been long understood that investors do not always trade in the way we would expect them to if they were behaving completely rationally. Perhaps the most relevant bias to momentum investors is our tendency to follow the crowd instead of our own analysis and favor recent information over older information. Momentum investors know that we have these biases, so they attempt to put themselves in a position to benefit from the logical results of investors acting in that way, by getting into investments early on in their trend cycle and leaving it before everyone else does. In other words, they're trying to outperform by timing the market sentiment of investors, as opposed to the market of investments. However, as promising as these results are, there are some other things that need to be taken into consideration before deciding whether momentum investing is really the right approach for ourselves. As I mentioned earlier in the video, there are some things that I wasn't calculating for in these simulations, like tax implications, trading fees, and other investment costs. And depending on your situation, those could make a huge difference. The long-term capital gains tax rate sits at either 0%, 15%, or 20%, depending on how much gains you're realizing. If you're a long-term buy and hold investor or investing in tax-advantaged accounts, this may not matter too much to you, as your capital gains each year are likely to be pretty minimal. However, if you're a successful momentum trader and you're buying and selling your investments in a taxable account, that added cost could wipe out a decent chunk of your additional gains compared to the buy and hold investor. In fact, given the 13% per year nominal returns we just saw for the 40-year all-stock momentum strategy, an individual with a $100,000 lump sum to invest would actually wipe out the entirety of their additional gains over the buy and hold strategy just because of long-term capital gains taxes. And don't even get me started on if you're trading more than once a year, because short-term capital gains tax rates are even higher in most cases. Of course, capital gains taxes aren't the only potential cost difference. There's also trading costs and potentially differences in expense ratios. Depending on the specific investments you're trading in, this may be incredibly minimal, or it may make a material difference. It largely depends on whether the institution you're investing in charges for your trades in some way, and how expensive, volatile, and widely traded the specific investments you're trading are. You can find out the first by contacting the place where you're investing your money, and the second by looking at the expense ratios and bid-ask spreads of the investments during market hours. The larger the expense ratio and the wider the bid-ask spread, the more expensive momentum trading is going to be relative to a buy and hold approach. Then there's a psychological aspect behind the decision. As we just saw, even when both approaches were investing exclusively in stocks during shorter time horizons, the odds of a momentum-based approach outperforming a buy and hold one before cost differences were taken into account were not too much better than a coin flip. So if you end up struggling as a momentum trader to start with, and then abandon the strategy, you could put yourself behind the 8-ball relative to a version of yourself that's simply stuck with a buy and hold approach. Granted, psychological considerations come into play for buy and hold investors as well, but at least with buy and hold investing, you can stick to your guns by figuratively burying your head in the sand and just not paying attention to market movements. Because once things are set up, changing nothing is the plan. With a momentum-based approach, you've got to be actively making decisions and trades on a regular basis based on those market movements. And finally, there's the fact that in recent years, momentum investing, or at least the specific segment of momentum investing that we're looking at today, has not outperformed buy and hold strategy by quite as wide a margin as it has in the past. I ran the two strategies through my asset allocation spreadsheet using a 10-year time horizon to get the idea of how the metrics changed over time. On your screen, you'll see the results. The first set of figures is for the 1929 to 2020 period we went over earlier, and the second is from 1976 to 2020. I should note that the asset allocation sheet does adjust for inflation, so the figures for the 1929 to 2020 period do look different than what we just went over, since the figures earlier were not being adjusted for inflation. You'll notice that the inflation-adjusted returns are a lot closer on average since 1976 than they were since 1929. You'll also notice that the buy and hold approach actually posted lower standard deviation and start date sensitivity figures and superior shortfall avoidance figures. Now, I don't know if I've used the shortfall avoidance metric before, but it's fairly simple to understand. It basically looks at every possible starting date during the time frame, as well as your time horizon, and shows how often the strategy managed to hit a specific level of returns. In this case, we're looking at every possible 10-year period between 1976 and 2020. And I set the inflation-adjusted return target to 6%. The buy and hold strategy met or exceeded that 6% per year target 75% of the time, whereas the momentum strategy, before cost differences were considered, hit it only about 67% of the time. And while the buy and hold approach did fall relative to inflation more frequently than the momentum strategy, it didn't fall by as much on average or at its worst. As a result of all these metrics, the Ulcer Index suggests that the investing experience would be noticeably nicer for the buy and hold investor than it would be for the momentum investor. In terms of overall resiliency, there is quite a bit of back and forth here, but it does seem clear that the momentum strategy manages to come back from downturns quicker despite falling further. Now, these observations may or may not hold true for every application of momentum investing in every area. There are other ways to implement a momentum investing strategy than how we did it today, and many other indicators that could be used to produce much more sophisticated asset selections than what we did today. For instance, some people invest in high-performing assets like we did, but also simultaneously short the worst performing assets in the hopes that the downward trend of those assets will continue. Others use technical indicators or other signals to decide when to buy in, as opposed to simply picking the top asset or handful of assets based on prior year performance. For example, using a 50-day or a 200-day moving average as a guide to decide when to buy and sell an asset is a relatively simple example of this. When the 50-day moving average rises above the 200-day moving average, you buy, and when the reverse happens, you sell. Though, obviously, there are also much more sophisticated indicators that you can use. This may also open a momentum trader up to regularly realizing short-term capital gains as well, which are generally taxed at higher rates, like I said before, so that needs to be considered, but it is worth mentioning. And of course, people use this momentum-based approach on all manner of investments, from individual stocks and bonds, sometimes in tandem, to sector ETFs, and broad-based market index funds like we use today. But this does at least give us a basic overview of momentum investing and how it might have held up against more traditional buy and hold strategies historically. And it also helps to explain why something so simple and seemingly great on the surface might not have been adopted by everyone. It does seem like it is very capable of beating the market, even if we don't have a consensus answer as to why that is. However, depending on your situation and which investments you're looking at, that edge may narrow significantly, if not outright disappear, after other factors are taken into account. And if you want to look into the strategy a bit deeper for yourself, I've got a couple of new spreadsheets up on my Patreon page that'll help you do just that. The first is a spreadsheet that allows you to choose from a variety of momentum investing assumptions and investments, including the ability to add custom ones for yourself, to see how a momentum-based approach would stack up to a buy and hold system. The second is a simple capital gains tax sheet that allows you to put in an assumed return for both the momentum investing and buy and hold approach and see how much of a difference those capital gains taxes could make in your ending net worth figures, depending on your beginning nest egg, ongoing investments, time horizon, and tax filing status. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.